Has the long-awaited stock market correction finally arrived? I think it has. I think we're going to have a crescendo this week, and then I think moving into next week and the end of the month and the end of the quarter, we're going to have the stock market correction that we've been talking about for a while now. Now, this isn't just an at-the-moment prediction, and it's not just done on a whim. We've been talking about this for a while, but the factors which affect it continue to move in our favor, and makes me believe more strongly than ever that we are due for a correction. Now, what I want to make clear, though, I'm not predicting 1929. I'm not predicting the Great Depression. I'm not predicting a monetary crisis right now. What I'm saying is the market has come a long way. A number of factors are leading us to believe that we are overdue for a correction. And we think there's a number of catalysts that could cause the correction in the very near term. And we think it's important for investors, even if they don't necessarily need to run out and change their entire portfolio, to be aware of these factors and how it could impact their portfolios so that they can make a move if they choose to do so. And the way I think I'm going to do it this week is we put out a long report earlier this week for our premium subscribers on Substack and our regular research service. Now, we have received so many requests to make this public that we are gonna make it available to regular paid subscribers on Substack rather than just our premium readers. So if this is something that you're interested in, go to research.santiagocapital.com, find us at Substack and subscribe, and you can get the full report. I'm going to walk through some of it today, and then I'm going to go through some charts as well, and I'm going to lay out the case why we think it's important for you to understand why it could happen. Again, this is not a guarantee. We don't know for sure, but we are prudent investors. We think a correction is on deck, and we are prepared for it, and we will even be more prepared for it by the end of this week. But essentially, what we see is a number of things that we have seen many, many times before. I've been doing this for 26 years now. I've seen it 3 or 4 times myself. But what we did is we went back through history and we looked at a number of very well-known bubbles and tried to figure out what's the commonality amongst all of them. And what we found is the same thing that we're seeing now. Now, again, this isn't a guarantee that we're going to have one of these fantastic crashes. It doesn't mean we're on the edge of the popping of the biggest bubble. What we're saying is the table is set that it could happen, and you need to be aware of the factors that could affect it. Now, what we typically do is when we write these reports, we have an executive summary, which kind of lays it all out. And essentially what we're saying right now is in our background section, there's 3 different conditions that typically breed the euphoria that the markets are seeing right now. And this is very much related to the AI phenomenon. And most of the market's return this year have been determined by the large cap tech stocks. And they are driving the majority of the market's return. And those large cap tech stocks growth are very much influenced by the AI bubble. Now, whether you want to call it a bubble, a mania, just a euphoric time, or maybe it's different this time, it is very much related to the AI phenomenon. And as we go back through history, what we've found is the conditions that breed this euphoria are found in every episode. And it's essentially inflated valuations, abundant credit, and a competitive narrative of progress. Now, all 3 of those are very much present in the market today. And if you look at valuations, just as an example, the Shiller-Cape ratio is high as it's been in 20 years. Now, it's not the highest it's ever been, but it's extremely high. And again, it doesn't necessarily, valuations are not a great timing tool. In fact, they're a horrible timing tool, but it is a data point of which you should be aware. And the valuations on some of these technology companies now are crazy. And what Oracle just went through this week is absolutely insane. I'll talk about that again a little bit later. But then not only that, but abundant liquidity. Debit balances in margin accounts are as high as they've ever been. And I was talking to a friend of mine this week named Ben, and I'm actually going to try to have him on the program at some point to talk about this. But this isn't even the biggest leverage that's in the system. There's a ton of leverage in the system that isn't even recognized because of the way 1 day and 0 day to expiration options have infiltrated the market structure. That adds to leverage that many people can't even see using traditional methods. But the bottom line is valuations are very stretched and liquidity is very prevalent. And not only that, but the euphoria is evident everywhere you look. It's on magazine covers, it's on TV programs. When you watch the news, it's talked about. And so all you have, the signs are there. Again, I'm going to say this 100 times this episode. It's not a guarantee, but the signs are there for anybody that is looking. Here's another liquidity measure. M2 money supply is as big as it's been. Now, this is not the government printing dollar bills. A lot of people say it's the money supply, all the dollars created in the last, most of the dollars created are created in the last 5 years. This is not the Fed printing money. This is the banking system loaning new money into existence. But it's clear that credit is abundant and it is being extended. And that contributes to liquidity and euphoria. And then the other thing that always happens in all of these episodes is you end up getting accounting misrepresentations, to put it politely, and fraud, if you want to be a little bit more blunt about it. And so again, we tried to look through all of these things throughout history, and it was very clear that all of these things existed in the tulip mania back in the 1600s. It was very clear, and they were all present in the South Sea bubble of the 1700s. They were all present and very clear in the 1929 crash that eventually led to the Great Depression. They were all clear and very present, and I was even around for this one, in the dot-com bubble of the late 90s and early 2000s. And these were all very clear and very evident in the global financial crisis of 2008. And then they were also present post-COVID in the SPAC and meme stock boom in 2020 and 2021. So again, all of these things are there for anybody who wants to go back and look for them. But it also exists in today's day and age. And the lessons you have to take away is that valuation discipline matters. It doesn't mean you have to sell your stocks just because they're overvalued. It doesn't mean valuations can't go a lot higher. It just means it's something to be aware of, and you have to pay attention to it. If you don't pay attention to it, you stand the potential of becoming a victim of it. The other thing that we just went over again, leverage amplifies fragility. When markets start to get fragile, leverage contributes to it, because the minute markets start to roll over, that leverage goes against the players in the same way, actually quicker than it helped them on the way up. And innovation and speculation must be separated. It is okay to be an AI bull and to understand that it is a transformative industry and a transformative technology. That doesn't necessarily translate into valuations making sense right now. And then finally, behavioral awareness is very crucial. You have to understand and be able to look at not only yourself, but other players in the market and see, are they acting rationally or are they acting irrationally? And then finally, liquidity, as I said, drives cycles. But let's talk about the new entrant that wasn't around in the previous cases. And we've talked about this a lot, and I've at least referred to it a lot, is that there's a new factor, and it's probably the most important factor. And this is the reason that we think it's important right now, and that we think that there's the imminent possibility of a correction, and that is passive management. Passive management has changed the structure of markets. There's just no way to get around it. And the thing about passive is there's no rationality to it. It is strictly an algorithm. In past times, there were people who at least had the ability to stop and think for a second. Now, it doesn't necessarily mean that they were thinking rationally. It doesn't necessarily mean they were making good decisions, but they did have the ability to stop and think and make a decision. That is no longer the case. Machines now make the decisions, and the prices on the screen determine whether something is being bought or being sold. And the sheer scale of the passive flows and how much it has impacted the markets now is something that I don't think people have a proper appreciation for. The same factors that can drive the market up really fast can drive the market down really fast. All you need is for a few stocks to start moving lower, and it can become a crescendo. Our friend Mike Green has discussed this many times. Anybody who has not studied up on Mike Green and his take on passive management is doing themselves a disservice. You should definitely do that. There's plenty of presentations on YouTube. You can Google him. You can probably even email him, and he will send you a plethora of reports. But this is a crucial factor. And again, this is why we think there's the possibility for a very near-term correction. But essentially, part of the passive phenomena is the way it concentrates money into a few stocks. And again, that contributes to fragility, because if and when those few stocks correct, it can have the effect of bringing a broader market down with it, even if the broader market is in relatively good shape. So this is really important to understand the market concentration. And right now, the market is extremely concentrated in a handful of stocks. And then, we mentioned this a little bit ago on the leverage, trading in leveraged ETFs. Not only do we have 0 and 1 day till expiration options now dominating market structure, we have 0 and 1 day options that are leveraged and 2 times leveraged and 3 times leveraged that affect it. And this is why things can go from fine to really bad really quickly. If we just focus just on artificial intelligence and we compare this to previous times in history, the amount of money that is going into AI and that's being thrown around for AI companies and the predictions that are being made about how much money is going to be spent in the years and decades ahead, some of the numbers are so silly you can't even fathom them. I don't have it right in front of me, but I think I saw a chart the other day that said for NVIDIA to build out what they've said is going to need to be built out over the next 5 to 10 years, it's something like 25% of M2. Now think about that. Think about how much money that is and how much that would need, how that would affect other markets. Of all of that money, 25% of M2 was going into the outbuild for a couple AI companies. You have to stop and think, is this actually possible? And if it is possible, what would have to happen for it to be possible? And then, finally, narratives, right? And again, the narrative is all part of it. Again, this is going to change the world. This is going to make jobs disappear. It's going to make everything more efficient. It's going to, make the need for UBI to come in again. But it's all going to be for the better, right? And it's going to lead to incredible productivity, et cetera, et cetera. And what I would say is, I don't necessarily disagree with all of that. In fact, I tend to agree with it. But just like in the previous times, the initial wave of euphoria typically gets washed out, and it's the handful of companies that were prudent and didn't get wiped out in the initial wave who end up making all of the money when that technology actually does become as prevalent in the world as they are currently predicting it to be. So again, you have to separate the narrative from the valuations. And then finally, questionable accounting practices in AI and technology. This has been seen in every other bubble that we've seen in the past. And listen, I'm not going to sit here and say that it is currently absolutely 100% existent in today's AI bubble or in today's AI companies. But there has been strong concerns that it is. And it wouldn't surprise me at all if we find out that that is the case. If it wasn't the case, it'd probably be the first time in history that it wasn't the case. And so you just have to kind of consider when you consider all these things together, and you consider the markets are at their highs, everything is stretched. And we have a number of potential catalysts now right in front of us, the least of which is the Fed meeting. And I would argue that many things are already priced in, that it's hard for me to sit here and figure out how is the Fed going to surprise the market on a dovish basis that then propels the market dramatically higher from there. In fact, I think it's going to be very hard for them not to be a sell the news event. Now, I don't know that markets are necessarily going to crash as soon as the Fed makes its announcement. And again, I'm not even saying we're going to have a crash. It's a correction. But the problem is a bit with the role of passive and with different potential catalysts, the role of passive can make a correction get out of control very quickly. And you should be aware of that. So I'll just leave that there for now. What I'm going to do is we're going to go through some charts and it'll kind of reiterate what I'm talking about. But one of the things I wanted to do before that is some of you know that I recently joined the board of Monetary Metals. The reason I joined the board of Monetary Metals, it's the first time I'd been approached many times to be a part of some different companies on an advisory basis. And the reason I chose to finally go with Monetary Metals is I really like the management team. Keith Weiner, I think, is a brilliant guy. Probably definitely in the top few smartest people in the gold space. And he came at this a little bit different than most people. He figured out a way to put gold to use as money in the real world. And if anybody's out there thinking that gold is money, well, this is your chance to actually put it to work, because you can put your gold with Monetary Metals. It can then be used in the real world to real world businesses who need gold and need gold financing to then go out and use that gold productively. Now, a lot of times people will say, well, I don't want to put my gold in a place that could potentially, you loan it out and you go into a lease and then you potentially don't get it back. Well, first of all, it's insured, so you don't have to worry about that. But the other thing is there's nothing wrong with having your stack of gold in some vaulted location that you don't do anything with. But you can have another portion of your gold allocation that does earn a yield. And this is why I opened an account with them, because I already own gold. I already own physical gold. But this was a way that I could have an exposure to gold that wasn't bullion on one end of the barbell, and it wasn't as risky as gold stocks on the other end of the barbell. It sits somewhere in between. And like most assets, there's a risk return spectrum, really safe to really risky, and many in between. That same thing exists in the gold world. But I opened an account with them. I plan on adding money to it every month. And, in a couple of years, I'll probably use some of it for my son's college. But again, it's a way to add to your current gold holdings. And what it is it's a way to earn yield on your gold. One of the biggest arguments against gold is that it doesn't earn a yield. This is a way to own gold and earn a yield on it. Now, again, you don't need to do this with your entire gold stack, but with a portion, I think it makes a lot of sense. And I'm going to show you one reason why I think that is. There's many studies, and many of you have probably seen this. When you add gold to a portfolio, it enhances the overall performance and provides diversification. And this chart here shows a number of different, allocations to gold in a portfolio. But the bottom line is if you have gold in a portfolio, you get a higher return and a lower Sharpe ratio. So better risk reward. But when you add gold with a yield, it actually becomes even more so. And this is the top line right here. So I think it's something you guys should think about. I encourage you guys to go over there and check it out. If you go to monetary-metals.com/Santiago, you can find a site that'll give you a little bit more information on it. Okay, so what we're going to do now is we're going to go over some slides. But we're going to do it. I'm going to show you something else. This is something else that this is also available for our research clients. We have two different levels. We have the $400 a year, which is the basic level. And then we have the $2,400 a year, which is the premium. The premium gets a lot of that report we just went over, you get at least 2 of those reports a month, plus all of our smaller reports, plus 2 live Q&As each month. So it's really like a big community. You get tons of different information we send out. On the basic site, we send out a weekly email. This is one of them, and we do some smaller reports. This is one of them, and this is meant to be really just an executive summary on the week that was, what happened last week, and then what's coming up next week. And I thought not everybody has the time to spend 5 hours on the weekend, figuring out what happened in the markets this week. So this is meant to be just a quick summary of it. But essentially, what it is we summarize the week that was. We talk about the different economic releases that came out, and how that affected markets. We talk a little bit about macro or some kind of a policy change that came into being, and how that could affect markets. The thing that really kind of affected me this week, and I'll be the first to admit, like I was really, really sad this week when the news of the whole Charlie Kirk thing. And I can't sit here and say I was a huge Charlie Kirk fan. I respected the hell out of him. I agreed with him on some things. I disagreed with him on others. But to me, that was just another red flag on where we're all headed in this fourth turning that we've talked many times about. And I was really bummed. It didn't really necessarily affect the markets this week, but my fear is that things like this continue and that it escalates. And then we do have to start thinking about that kind of stuff as it affects markets. But in the middle of this report, we basically have the week that was. We have a quick little policy and macro overview, and then we just go through a ton of charts. And so anybody that subscribes get this every week and gets all of these charts. And so if we look at the charts, and we're just going to run through a bunch of them now, we can see everything's back at its high. And the reason I think this is important is it's not just one or two things. Everything is very, very extended. We think there's a number of catalysts on deck that can push things lower, especially when we talk about the role of passive. The least of which is the Fed meeting. We have tariffs that are now starting to hit. We have a number of geopolitical tensions. We have other economic data in spite of the Fed that's going to be coming out. We have other central bank meetings around the world. And not only that, it's just kind of time, right? We've come a long way. Everything's overextended. The VIX is at lower than 15. And September and October, for whatever reason, oftentimes are a little bit more volatile than other times of the year. But when we look at the Dow, you can see it's basically at its high. RSI is overbought. Stochastics are overbought. RSI is kind of neutral to flat. The S&P, kind of the same thing. The S&P is at its all-time high. It's almost overbought, not quite, but close to overbought. Stochastics are very overbought. So again, everything is trending very strong. Sentiment is through the roof, and basically there's no fear in the market. Same thing exists for the NASDAQ. Same thing exists for the Russell 2000. But it's not just the United States either. The same thing exists in the UK. In the UK, you can see the momentum is already completely rolled over. And typically when that happens, it's only a matter of time before price follows. Same thing when you look at the DAX. The DAX has actually come off a little bit over the last month, but it's still pretty high. It's sitting right at its 50-day moving average, or I'm sorry, it's sitting right at its 100-day moving average, still above the 200-day moving average. But the stochastics are oversold and falling. And so oftentimes when you get things when the momentum is gone, but the price is still high, you will often get the price catching down to the momentum. Euro stocks, kind of the same thing. The Nikkei is at its all-time high. And it's very close to overbought on the RSI. Its stochastics started to roll down. They've risen a little bit this last week, but everything is very stretched. Same thing for the Hang Seng. Same thing for the Shanghai. The Shanghai was very overbought a month ago. It's not quite as overbought right now, but close. But the momentum has again turned down. So again, we wouldn't be surprised at all to see that roll over. Same in Brazil. And look at Nvidia, went below its 50-day moving average last week. It kind of bounced back above it this week. And you can see it's trying to regain its momentum. But when you look at the stochastics, the momentum is just all gone. Wouldn't surprise us at all to see Nvidia go a little bit higher this week and then, roll over into October. I think we could easily go down to the 100-day moving average, potentially even the 200-day moving average. Same thing with Microsoft. It broke the 50-day last week. Now it's testing it from the underside. Momentum is gone. It's trying to rally, but my guess is we see a little bit of upside this week, maybe even into early next week. But by the end of the month, we think it's rolling over into October. Freeport McMoran, kind of a similar story. JP Morgan's at its high. I actually think that financials in general are going to struggle here in the fourth quarter. So it wouldn't surprise me at all to see this one roll over. Yields are low. They've risen just a little bit in the last week, but I think it's showing that the yields are lower than they were earlier in the year. And whether that's predicting because people are predicting what the Fed is going to do, whether the market's predicting some kind of a risky event, I don't know. But yields have come off of their highs earlier this year. Let me just the curve spreads are coming down a little bit. They're much higher than they were at the beginning of the year, but they've started to come off. Let me just go through a couple more here. The CDX is basically pricing at the lows. So it's basically shown there's no fear in this market. Everything is kind of priced to perfection. And it's our experience, doing this for 26 years now. When everything's priced to perfection, things typically don't go perfectly. Same with the high yield CDX. Crude kind of stays in its band. It continues to trade lower. Brent the same. Natural gas just, it's been down all year. It had a little bit, or since the spring, it had a little rally here, and now it's rolled over again. We'll see where that goes. Gold finished at its all-time high. Gold is extremely strong. Stochastics are through the roof. RSI's through the roof. Typically, when you get this high, you're due for a correction. But it's been very, very strong. As we said earlier, everybody should own gold. It's an important part of a diversified portfolio. Same for silver. Silver's been incredibly strong. Typically, when we get this extended, we get some kind of a pullback. Whether that happens this week or next week, I don't know. And maybe it won't. Maybe this is silver's time to shine, but we've come a long way, and I think it could easily listen. If silver came back and tested its 50-day moving average at the high 30s, it still had a heck of a year. So don't be surprised if we have a pullback there. Copper just kind of can't get out of its own way. But it had a hard sell off over the summer, and now it's kind of been trending higher. We'll see where it goes from there. Corn, wheat, they're all still pretty low. The dollar, is basically at its low of the year. No momentum at all. Everybody's negative on the dollar and positioned against it. Euro, nothing really negative about this chart per se, other than if the dollar's very oversold and gets a bounce, then the euro probably comes down with it. Same for the British pound. The yen is just kind of range bound. The yuan has been strong. But with some of the things they're starting to now have to bail out their local governments, that could impact the strength of the yuan. Bitcoin trying to get back to its high. It's had a pretty good year. The momentum rolled over, but has been coming back up now. And then Ethereum has been very strong or all year. It had a correction here last month, and now is trying to make a move higher again. The gold positioning, I think what's pretty interesting is both for gold and silver, as prices continue to go higher, the shorts have remained, but they haven't aggressively gone against it. So, I would say the shorts, the commercial short position is extended, but not dramatically so. So we're going to have to wait and see kind of how that plays out. Long story short, everything's at its high. We think everything is due for a correction. We're not predicting the Great Depression. We're not saying that this is the 1999 dot-com crisis. It's not necessarily the 2008 global financial crisis, but we do think that there's a correction that's on deck, and we think it has the potential to get strong just because of the new effects of passive that have not existed in the past. I think that's where I'll leave it for now. Again, I can't tell you what to do. I can't tell you what the most appropriate thing for you to do in your portfolio. All I can tell you is that we're positioned for a correction. We think it will happen here in the next few weeks, and we think investors should be prepared for it. Again, go to Monetary Metals, check it out. Hopefully you guys see the value in it that I do. That's monetary-metals.com/Santiago. And we will be back again next week. In the meantime, if you liked what we went over today and you like these reports we just went over, visit us at research.santiagocapital.com. All right, guys, have a great weekend. Bye.